Good morning, everybody. Happy Sunday, happy afternoon, happy evening, happy Monday, happy whatever day of the week it is that you're going to be watching this. But I do want to greet you all as we are about to go into the most important week of your lives. We're going into big tech. 5 big tech companies reporting this week. The FOMC meeting, CPI, or not CPI, but the GDP, and we've just come off a 2-week cycle of absolute awesomeness. Absolutely awesome. And I'm going to scroll through that with you here. But as we go into this, I always want to bring you back into some reality, into how it applies to what we're doing, because all we're doing is playing a video game. And as most of you know, I'm going to be 50 years old in 2 months, and the only thing I do other than the stock market is go to the gym. I'm at the gym every day. I hit my deadlifts every day. And here was a video just throwing back. And, what you see dedication, you see focus, you see concentration, and you see doing one exercise properly. One. This is what today's trader is. This is 2022. The best part is the boom box that he's got on his left side. A little cassette player. He's got his baseball bat. And you got to love the rainbow Crocs up on the front. Now, he did it, right? He did it. No question, he did it. But did he do it right? That's the question. And what I mean by that is I'm seeing that a lot of guys are getting stuck in positions. And when they're getting stuck in positions, they're getting stuck mainly because they're going into stuff unprepared and either sized improperly. Every now and again, the market's going to run over you. It's always going to happen. Whether you're on the upside, you're on the downside. The market is going to run over you every now and again. I'll go over it later on, how we saw it happen this week with the SPX. But before we go into that, again, want to bring you in is to the number one reason why, and I'm doing this now 25, 26 years. This is why people fail, I want to be a doctor. You go to school for 7 years and you got training. I want to be a lawyer. Go to school for 4 years and you got to take the bar exam. I want to be a pilot. You got 3 years. You got flight time. You got training. I want to be an engineer. Yeah, I want to be a trader. All you got to do is put money in an account and boom, you're trading. And that's it. You got no experience, no training. And what scares the living shit out of me is when people tell me, man, I'm doing great. I have no idea how to chart. The chart is your Bible. The chart is your heart. It's your cardiovascular system. Without a cardiovascular system, you're fucking dead. So, again, the reason I bring it up is because I'm getting a lot of messages. And yes, it has been successful to an extent for some of the people. But when you're in puts for NVIDIA, puts for Amazon, puts for Tesla, puts for the SPX, puts for the QQQ, you're doing what that guy was doing on the deadlifts, where you've got 19 different things all to do the one simple exercise. Pick one. Pick your one and stick with your one and let it go ahead and be that maximum gain, that maximum muscle building, that maximum everything, so that if you get injured, you're not getting injured over here on the left, over on the right, on everything else. You've only got one thing that you need to control, one thing that you need to focus on. So, again, bringing it back into the realities of things, that's the same thing when it comes to trading. Even though it sounds delicious, you got this, you got that, you got that, and you got that, and everything's fantastic, which I'll go over in a bit with Friday. It's having too much on your plate, and it's very hard to manage your plate because you're basically eating at a buffet where you could just go to the buffet like I've done. I do it every year at Thanksgiving. I go to the meat and I will get turkey and I will get steak and I will continue to go there until I have had an adequate, sufficient amount of turkey and steak. And then I'll go over to the pastas and the other things. But stick to the one thing where you're going to get your maximum gain, your maximum protein, your maximum result out of. And that's basically all I got to do is say from a mental point of view, from where you got to do be for your trading. But again, this is a big week. It's a massive week. It is a huge week. And I want to go over where we've come from and how we've gotten to where we are. Because again, on these earnings plays that we're throwing out for these spreads, every single one has played out. Every one except Snap. And I don't know anybody that got filled on that Snap. I didn't. I tried using the profits from IBM. I couldn't get filled. If you come back here, week of July 15th on that video and the setup where we had there with Pepsi, full credit, full payment, absolutely amazing play on that Pepsi. Come back here on the JP Morgan 2 weeks ago when the earnings began, both of these played out, both the call play and the puts play. Come over here on IBM, free money. You guys saw that beginning of the week, boom. Come back here on Netflix, again, boom, free money. Excellent. Come over here on Tesla. Not only did the spread play, but then the calls actually played on Friday. If you held on to those under $8.50s, they went up to $4.50 on Friday morning. Snap earnings. Again, I tried to get filled. I couldn't get filled. I didn't get filled. But as I had said here, I'm only going for 4 using my IBM gains on this. So if I did get hit, I would have only gotten hit with what I got hit with what I made off the IBM. But again, I don't know anybody that got filled. Nobody messaged me about getting filled because with Snap, we've mainly been trading the shares rather than trading the options. Come over here onto where we were on Monday. And as we went into Monday saying how we were embedded, overbought as we went into the end of that week and where we were looking for that dip. Boom, 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 boom. Everything worked out perfectly on that. And I straight it out here on Monday. Just remember, we're playing a dip, dump, and then a rally into next week, FOMC Tech. So this is a dip expected only. And that's exactly what we wound up with. And again, going here on to Tuesday, again, stressed it. You know, you've got SPX 3,800, 3,881 downside. We were in no man's land when all of this went out. And then all of a sudden, the euro came out with that rumor that they were going to do a 50-point hike, and we completely took off. The trade that I had there on Tuesday was to sell the put credit. Sell the 3,800s, buy the 37.95s. Didn't expect us to be going up much higher than that, but again, we had the July 20 calls on QQQ and SPY that were in play, the 22s that were in play, and all of these. You go back and you look at these were all 5-baggers. Every one of these was a 5-bagger because, again, we were expecting it to be a dip or a dump and then a rally into next week with the FOMC Tech. So this is a dip expected only. Kept it in the email all week long. And then on Friday, again, full credit, trouble, dipless, still going higher. There it is. It's a dip to be bought. SPX 39.23 is the new support if 39.68, 39.45 break. What we got there, I'll show you when we go in there in the chat. We had the 5 days where everything was just up a little bit too much. And we had our trade setups for that day, for Friday. Sell the 40-40 calls, buy the 40-30 calls. You got a 10% return. Again, coming into that, I'm sure I corrected this when we were in the room that this was reversed because I know 2 people that took the trade. SPX and SPY puts have been morning scalps at best. And then we came out here with the call spreads over here on everything. I like the Netflix. Netflix paid out. Tesla paid out. Amazon paid out. NVIDIA paid out. Apple paid out. Everything. And as we said, it was just a dip going into that. And coming in here, looking in here onto the Friday when we were trading on the Friday, and threw it out there for where are your puts right here, 8:30 in the morning. SPY 397 puts. Scalp I would have in mind, your SPX 39.60. Then you've got your text weight. You've got all your puts in play, your Tesla 820s, Apple 155, Amazon, NVIDIA, AMD, Shop, SQ. Every one of these paid out. Every single one of them paid out more than 100%, 200%, 300%. And then later on in the day, where I was saying there was that, yeah, we were looking for this to be a bullish bounce, 39.84, looking up there, 40.30, 40.47, and that's where I'm going to go into as we go into this. Because again, we got that nice little dip where I'll show you here. Let me pull it over. The dip that we got was right down to the 5-day moving average over here on the ES. Right down to the 5-day moving average, right there on the lows of the day, and then the bounce back up. That's as bullish as you're ever going to be able to get. You weren't embedded oversold until, as we were over here on Tuesday, and then we just had this running sell divergence that just refused to go anywhere until we had that little bit of a dip there on Friday. Held above the 5-day, held above the 50-day, obviously above the 10 and the 20-day. This is bullish going into where we are going into now, which is the biggest week of the year, the biggest week of your lives, because where we are looking at right now is going to be one of the most epic setups you could ever expect. We've got new home sales on Tuesday. We've got nothing on Monday. Therefore, because we have nothing on Monday, we should start to see a bounce come in from where we were coming off there on the Friday lows, and I'll run over that and show it to you in the charts. On Wednesday, you got core durable goods, you got pending home sales, you got crude inventory, but most importantly, at 2 o'clock, you got the FOMC statement, you got the FOMC decision, then you got the FOMC press conference after that. Some people are already betting that there's a 0.75, a 1 point. Doesn't make a difference what it is. Charts are still going to tell you where you're going to be headed to. And on Thursday, we got the GDP for Q2, where they are looking for plus 0.04% on Thursday. We got the initial jobless claims, which have been climbing for weeks. And then on Friday, we've got the core PCE. We don't get the CPI data for us until next week. We also don't get the jobs report until next week. But you've got the CPI here year over year on Europe coming out on Friday, as well as the German Q quarter over quarter GDP. So Friday night, very close, or Thursday night, could very obviously be some fireworks as we go into the end of this week, which again will come over here because again, everything is in your charts. Looking here at July, right? We started July at 37.81. We closed here at 39.61 on Friday. So that's basically about 200 and, or no, well, do your math, however you want to do your math. We had a green week. We had a high of 4,012.44 on Friday. We have not been in the 4,000s since June 9th, which we have that gap, 4,012, 4,017.82. So we still have 5 points, which is nothing when you're talking about the SPX. So if you're really, really embedded that you're looking for that 5 point gap to be filled, you can cross your fingers, you can pray to the West, sacrifice a chicken, do whatever you got to do. It's not as important as where you are and where your charts are, where you're trading with. We're on a 7.82% rally from last week, Thursday's low at 37.21. We're at a 10% rally, 10.33%, 375 points since the lows, the June 17 lows, 36.36. And I want you to bear in mind that because we've only moved 290 points this month, whereas every other month we've been moving 500, 450, 480, 600 back there in January. When you're bearish, you move a lot more because it's just like you see here. Again, I'll bring you back here. This is bullish and bearish. This is bullish up. You see the energy that takes to the lower, and then this is bearish going down. It's a lot easier to go down than it is to go up. So therefore, when we're looking at these points for the month and we're thinking about, how we should be looking at a 500-point month, we're up 375 off the lows. I think your count is much better applied counting off of the lows from June rather than counting for the month. You're missing out there on 80 points, basically 85 points, and that is significant to an extent to where your upside is, yes, it's there, but at the same time, you're very limited to getting to that upside. And I'll show you how we're looking at that when we get into the charts. Here's inflation, okay? And I wanted to go over this earlier. I looked over it on Saturday, and then I found out, you know what? It's not even worth it, because you had this rise here from 1960 to 1980 with Vietnam, and then stagnation, the Iran oil crisis, which very few of you remember, when you were only allowed to get a gallon or 2 gallons of gas every day. Then again, gasoline was like 50 cents a gallon, but you were only allowed to get like a gallon or 2 gallons of gas a day. People were pushing their cars. I remember pushing my dad's Ford Torino into the gas station when I was like 7 years old so that we could get gas. And, you had inflation up here above 10, up here, it's peaked in 1980. Oh. And when you go look at the charts, man, the charts are climbing just as much. Yeah, you had a dip exactly like you have here in the inflation number, but it's a noisemaker. It means absolutely nothing. So anyway, looking at our charts, I'm looking at this from a couple of different points of view, and I'm trying to be bullish on all of it because there is so much bearish sentiment out there, where at the same time I will show you where the bear starts to become applicable, and I'll bring it in here. This dip that we had here on Friday came right to our 23.6 retracement from the lows that we placed last week Thursday. So from a bullish point of view, it is sufficient that's it. The dip is over. It would have been much nicer to get a dip down to 3,900 to the 38.2 retracement, which is also the 50 retracement from the big drop down in March, but it's not required. That 23.6 dip right there, sufficient enough for this to be a bullish fourth wave of this wave 3, and now we should see the final fifth wave of wave 3 somewhere up here into that 40 30 40 70 area, which I've been pointing out in the charts for about a week or two. If we can get up to that 41.15, this is going to be the greatest short you've seen since Russia invaded. It's going to be the greatest short since March. It will be an incredible short to get into if we're able to get up to this 4,100 level this week. It will be insanely, incredibly awesome. Again, zooming in, how we've had this move here off of last week Thursday, we can see here we have a 1-2, and this is definitely a 3, extended up there right above the 100 extension. We're not on that 100 extension from the other drawing coming back, as we're looking here, where our June low, our 2022 low, is the beginning of it. We had our one with that 8.5% run. Then we retraced more than 61.8 on that, almost a failed triple bottom right here, which is fantastic. Quadruple bottom, really. And then, boom, we have this rally that started here, which has been a 10-point run. 10% from here, 7.2%, if I was right, 7.82, backwards. 7.82% from last week Thursday, which is where this is. This is your 7.82% rally over here. And again, this drop down right to the 5-day moving average here on Friday to that 23.6 retracement is the minimum requirement that you would expect for this to be a bullish fourth wave start of this, so that we can start progressing forward and start seeing this head up into that other level up there in the 4100s. Again, this is the same chart that I had been looking at for a few weeks, where we're looking for that 4047, and we haven't quite hit that 4047 as of yet. We've got a resistance line here, which is coming from the March levels. We've also got our trend line here, which is coming off 2016. So, yeah, we're coming into a bit of a confluence over here, and could be a little bit difficult to navigate, which is why you've got FOMC, you've got all these earnings, and all of these catalysts that are here to either gap you up above those, because you're not going to break these intraday. These are to be broken via gaps. That's the way that they get broken. And then after they're gapped up, and I would bet you that what we're going to wind up seeing here is something around here in this 40.25 area, 40.30, as we go into the FOMC meeting, and then gapping up above that, so that we've got that meeting, which could come off of the Google or the Alphabet earnings. I doubt that either one of those are going to be, Google or Microsoft on Tuesday, which I don't think either one of those are going to be big catalysts to drive us to the upside, but hey, open-minded. But yeah, this is the big view that everybody's looking at. This is everybody's big bearish view. And the reason why it's that big bearish view is you can see here on this red trend line coming off of the 2016 lows and the December 2018 lows, you fractionally were down below that for a couple of days back over here on COVID. And everybody's looking for something down in here in this 3,400, 3,300 level, which I've got a whole list of reasons why that should be on everybody's radar. But as of right now, it still is not, because we have a few things that need to be taken care of before we can start looking at that aggressively. Where are we? Charts. So here, SPX, a lot of information on this chart. I'm going to break it down for you one by one and start removing it all. First of all, the MACD. This is the daily on the MACD. And what I'm looking at here, and I want you to see, is how I've got this 25 line. And as you can see here on this 25 line, even going back to prior years, once you start getting up to that 25 over here on the MACD, as far as you see on these volume bars on the green, you're getting a little bit over aggressive, and things are going to start turning to the downside very shortly. And as you can see, very shortly, they all do tend to point out. Here was your big spike here in March. This is on June 2nd of last month, June. Here you are with your big spike up. This is March 29th where you hit your high. And as you remember, we had that big rally over there into March 30th, March 31st. So again, it is something that needs to be looked at but not focused on. Okay, MACD, remove. RSI. So again, here on the RSI, you've got your 70 line, which everybody's got as a default. 85 is where I start calling for overbought. 85.90 is where my overbought level is. And this is on the daily that we're looking at here. And as you can see here, you had this bullish, absolutely bullish, coming off of October, November, where we had that 11% run as we went into November and Thanksgiving, before that dip in the final ending there when we went into the start of 2022. Oversold over here in January as we had that sell-off. We got oversold here in June as we put in that, low, and you had that buy divergence, which is again why we were really bullish coming off of all that. But this is where the concern is how we got up here to around 78, 79, and as you can see here, here's your March high up here in the 80s. And again, being up here in the 78 level, you can see here where all your rejections were coming right above that 70 all year long. So, again, the RSI is starting to tell you, hey, you're a little bit too bullish and you might want to be careful with what your upside exposure is. Studies, edit studies, RSI, remove. So here we are now just on the chart itself, looking at the daily. And this trend line is that one that I was showing you there in the chart over here. This is your red trend line right there. Okay. And here you are here. It's your resistance. So it's quite obvious. There's an enormous amount of upside to be taken care of. Incredible amount of upside. And more importantly, here in green, I've got your 50 retracements of the entire drop. And what you would like to see is a retracement here to this 4088. So that's basically a 38%, 38.2% retracement of the entire drop, which fits, again, into my charts that I've shown. Going back, where we're looking for something up in that 40-47 area. We've still got that gap up here, but we're looking for something up here around this 40-47 area is what we're expecting. So, again, looking at that area, and then again, your 42.2775 is your 50 retracement, lines right up with your 40.22 over here in the January low. I mean, there's a lot of artisticness that's involved here in this, and as you see, we've reclaimed the 50-day moving average. The 100-day moving average is going to be up here around 41.36, which fills that gap, and then your 200-day moving average is way up here. Forget about it up here in the 43.30s. But, again, this is where we are. So we start removing these things one by one as we don't need them. The 100-day we don't need. And even the 50-day, I mean, you could leave it, but you don't really need it. But then again, I'll remove my 1334s. That's your 20. And I'll remove my exponential moving average so we get a little bit cleaner. And here again is your 5-day, your 10-day, and your 50-day. That's what's left here on the chart. And again, this is the daily. So we'll pull it out here onto the 30-day. And you know what? It's going to be too much. But yeah, if you can, bear with that. Here's your 5-day, your 10-day, your 30-day. You know what? Yes. I am going to do this because I can't stand having dirty charts where I can't see what I'm looking at. So here you see your 50-day moving down and swinging, and it will eventually start to flatten out because it's 50 days. This is a 30-day chart going back here, and you've got the June lows, the 2022 lows, and here we are. But what I want to show you here is this channel, which I've drawn out here. And you can see this channel coming off of these lows here back in May. Here's your gap down over here in June, coming right off the top there. So I like this as a channel. And again, fractional upside to around that 40-40 area, 40-50, and then coming back down over here. But again, one of the things that I want to make clear and bring to everybody's attention is the wider view, which, you know what, I don't have it here. I'm going to need to pull it up, and I'm going to need to find it, actually. Web view. Yes, video. I knew I could find it. Yeah, we can see that we had a 5-wave down here, and then we had an ABC retracement, and then we had 5 waves down here, which was our A, and then a B, and then another retracement. Or again, you could be looking at this differently. 1, 2, this is your 3, this is your 4, this is your 5. I've looked at this several different ways and drawn Fibonacci's on all of them to see how the highs were, how the lows were. And like here, for example, here was your 1, 2. Where did we come down to? We came down right to the 223.6 extension. Here was our bounce, 1, 2. We came just above the 100, below the 150, where we topped out. And then again, here was our next bounce, 1, 2. And where did we make it up to? We made it up to right to the 150, between the 161.8. Now, and it's the way that this has been progressing. And, you know, as we are here looking at this from where we're at right now, this being a 1, this being a 2, here's our 100 right here. Above that 100, you know, we'll throw the 123 and the 168 with the 150, and everything fits right in here that we're looking at. That 40-30, 4103, somewhere up into that area after this dip has already completed, if we completed it already on Friday. And this spike up here will be one of the greatest shorts that you've been able to come across, not only in months, but probably in years, unless you were already short with us back in COVID, unless you were already short with us back in September of 2018, unless you were already short with us back in 2018 in January when that whole thing took place and we had that little bit of a dip. This could be an incredible short back to the downside, back down to this 3650, back down to that 3400 level if we do get that break. And it's going to take a lot to get that break because, you know, here you're basically looking at a bear flag. And from this bear flag point of view, it would be better to be up into that 40.88, 40.50 area before you start getting into a big short. Coming over here to the VIX and where the VIX has fallen off to, we broke down below that 2371, which was our low over here back in June. So now what we're looking at that 2102 as likely being our catalyst for where we start to bottom out, which again, it's following this trend line, which was the resistance line over here. It's now being the support line all the way down. And again, with everything now below the 5-day, the 200-day, the 10-day, the 20-day, the 100-day, the 50-day, 1, 2, 3 gaps, something is going to come out at you, and it's going to come out quick, and you're going to see this spike right here where you were down here at 20, at 19, right? On a, what is this, the 21st, and then here on the 2nd, 2 weeks later, you're up here at 36. Same like this, 2371 on the 8th, and over here on the 13th, a week later, you're up here in the 30s again. So again, where I'm looking at now is a very conservative upside continuation, but getting ready for this to undoubtedly be spiked back up into the 30s, where again, we can start shopping again for that short play, because when you get up into the 30s, you're always going to get that rally to be bounced off of. So, again, this is, again, that gray area is a major concern to be coming into in that zone right here. And I'm going to play a little game with you for those that haven't taken the chance yet to get into their charts, right? And like here, this is yellow. This comes to this high. I've extended it a little bit further so you can see where the low is. All right. Here's your 2009 low, and here's your retracement up to your high right here in May of 2011. And you come right down to the 38.2 retracement. Okay. Here's February of 2016. Your run up to February 2016, you peaked here in May. May of 2015, we peaked at 2134.72, and it took us all the way until February before we got that dip, and the dip came down almost to the 23.6 retracement back to the 2009 lows. Now, again, come out a little bit further, and you're looking at what happened here in 2018. You come out here in 2018, your 2009 lows right up here to 2940. 2940 was where we peaked. Right here, and if you guys remember, I had 2391 was where our top was supposed to be. So right here, boom, boom, short, big October down, November bounce, and then the December crash. And you came again right down to that 23.6 retracement to that November. Now, because of where we are here and because of how that November shows up, I'm going to remove it, right? Just so you can see better. But here's your 23.6 retracement going to your COVID high. Your COVID high right here. And then you had, sorry, not your 23.6, your 38.2 retracement was right down to your COVID low over here on the 2009 lows. So again, where that brings in everything into question, removing these, so you're looking at the same cleanliness. The 38.38 that we've been playing with for the last couple of weeks is because it's a 23.6 retracement to the 2009 lows. That's where we're at, right there. Now, if we get a move back to this resistance level, what we are looking at then is bringing into play that 38.2 retracement, which is just below the COVID lows, right around here. But more importantly, right at that 35.05 level is your 50 retracement to the COVID lows, right down there. So, one of these big games in this video game that's going to be looked at here is how we're able to manage ourselves when we do come into contact with that resistance line right there. How we manage ourselves when this red resistance line comes into contact is a big question that we will find out when that time is right. For right now, all that we're looking at is we're looking at that level to be into this 40-30, 4100 level, which is a 70-point level as we go into this week. Basically looking at 100, 120 points to the upside where we're going on to that. But again, when you come back into everything, I apologize for repeating again. This month of June or July, since we started this month, we've been green. We have been green the entire month. All month long, even on the lows, we were still green where we closed. Am I right? Hey, hang on, man. I ain't right. That ain't right. It is right. Oh, I'm looking here at July 5, 37.81. We closed here 37.90.38 on that July 14th. 37.81 is where we started the month. We have been green. I am right. we have been green the entire month. We're up 4.78% on the month. So again, being bullish would mean that the upside is smaller. So looking at this to be a 400, 500 point month would not be the right way to look at this as we're going into next week. As we go, I mean, I can extend it back further, but I don't really have to. If you come back and just look at yourself from, a 3-year view, even as bullish as all of this was for 3 years, you come by month on month, these months are not humongous months. You're not getting months of 200, 300, 400, 500 point moves. It's just a gradual increase to the upside. And that's exactly what we've had here over the last 30 days. The last 30 days has just been a gradual increase up to the upside, which again is bullish. It is very bullish. And unfortunately, last week, because of the way that it played, we had that big gap up in that spike there on Tuesday. And from Tuesday, after that move reached up way up here, well above everything, broke those upper Keltners, which never, ever, 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 ever happened. Never, ever happened. And it did it. And here we were on Wednesday, and we just couldn't get a dip. We could not get a dip. So again, this is still bullish. This is still bullish. We are still looking for somewhere up into that higher level, up into our 40-30 as a minimum, somewhere up into that 40-60, 40-50 area, which I'll bring back onto the charts and start showing where we are. We've got a fractional little gap that has to be filled up here in this area. But yeah, this should be, for the next couple of days, a bullish opportunity to get back up here into this 40-12, 40-30, possibly even up into the 40-50, 40-70 area before we get into the FOMC meeting, and then the GDP, and then the European CPI, and everything else that could say, you know what, man, it's the end of the month. Let's just sell everything. So bullish to start the month, bearish to end the week is the way that we're looking at, bullish to start the week, bearish to end the week is how we're looking. And again, when you go into all of this, don't be this guy. Don't go in trying to have 19,000 different things going on at the same time. Focus on your one. Focus on your one. Do it right. Unbelievable. And I guarantee you he's an American. Have a great weekend, everybody. See you tomorrow.